All right, we're going to begin analysis of active portfolio management. And I gotta tell you, it is a deceptive little chapter. It seems like it wouldn't be much. You've got 6 learning objectives. It's tucked away in a small little section in level 2. You think, well, 2 readings to go. I got this. And it can be downright unintuitive and tricky if you let it get to you. But I'm going to take a little bit longer than I like for A, B, and C. We'll find D, E, and F go very quick, like less than 10 minutes for those 3. But the bulk of this is A, B, and C, and especially when we get to C, state and interpret the fundamental law of active portfolio management. I want to make sure that when we get there, you completely get it, because that's where a lot of people get lost. So let's just begin. And again, along the way, I'm going to go very slow, and I'm not going to make any leaps. I'm going to have all the tiny little dots along the way. I'm going to connect every little dot, and you might find that it's a little bit tedious to connect every dot, but you will thank me when you get to the fundamental law, because it'll all make sense without having to really think deeply about it. So the objective of active management, the objective is to add value by doing better than a benchmark portfolio. I think we get that, right? So we're looking at a relative performance comparison. When we talk about active management and how we measure active management, it's a relative performance comparison. Let's talk briefly about our choice of benchmark, because later on I'm going to talk about the optimal market portfolio and the benchmark. And the big question will be, well, how come the optimal market portfolio is not the benchmark? Well, let's just see what we have here. And this will be important too when we talk about our ability to take positions. So number 1, the benchmark should be representative of the assets from which the investor will select. Now the benchmark, again, can be anything that you're benchmarking against. If you're investing in biotech stocks, so that you're going to run a portfolio of biotech stocks for a larger fund, of which you're one asset class in a larger fund, but that's your section, well, your benchmark will be a biotech benchmark. It will not be an optimal market portfolio. It'll be some benchmark that is relevant for the asset class you have. So number 2, positions in the benchmark can actually be replicated at low cost. And number 3, benchmark weights are verifiable ex ante. That means we can look at the benchmark before we replicate it, and we can determine what the weightings are on the components in the benchmark. They're available before the fact, and return data are timely ex post, which means that if we end the quarter on the 31st of December, 1 minute after the market closes, we should be able to see exactly what they are. So that's the qualities of a good benchmark. The return on the benchmark is the weighting on the sub BI is every asset, all the components within the benchmark. So the weighting per component times the return per component. I don't think that is difficult to remember. We've seen that before. The weighting, the return on the portfolio is just the weighting of each item in the portfolio times the return of that item for securities I to N, and N is the number of securities. So this is important because we're going to work with this quite a bit. We're going to work with this notation, and we're going to subtract one from the other within this notation and come up with other derivations of this. All right, so you'll recall that we've already mentioned this in another reading. Our active return, R sub A, is the return on the portfolio minus the return on the benchmark. And alpha, which we can distinguish from active return, most people think the active return is our alpha, but that's not necessarily true. If we're talking about alpha, the alpha of the portfolio, it's the return on the portfolio minus the beta of the portfolio times the return on the benchmark, the sensitivity of the portfolio to the benchmark. And that's a risk-adjusted active return, which would be alpha. So let's deal with our active return for now. And we can break active return down into this. If it's the return on the portfolio, remember we said the return on the portfolio is the weightings of the individual assets times the return of the individual assets. And on the benchmark, it's the weightings times the individual weightings times the individual returns. So we can just subtract these two. But we can take the common, we can sort of isolate this and take the common term out because we have Ri in both. So it's just the sum of the difference between the two weightings multiplied by Ri. I think you could see that. This is a common term in both, right? See this over here? Let me find a better color. There's the common term. So if we're taking the weightings in the portfolio times that minus the weightings in the benchmark times that, we can just collect the terms and put the weighting in the portfolio minus the weighting in the benchmarks times the return. And this is per security. Well, this over here, we're going to refer to by this term from now on, delta WI. Now, the delta means active. These are active weightings. So the delta WI are active weightings. So to determine the active return, we don't have to figure out the return on the portfolio and the return on the benchmark and subtract them. We could just look at the difference on each security, difference in the weightings, and multiply that by the return of each security and get the same return, the same active return. Now, this active weights has a certain property. So let's look at the active weights for a minute. We know that the sum of the weighting in the portfolio of all the components must add up to 1. I think we get that. And the sum of the weightings in the benchmark, when you add up all the different weights in the benchmark, they must add up to 1. So they both add up to 1. Well, if the sum of the weights on the portfolio add to 1 and those in the benchmark add to 1, it's easy to see that if we take the sum of the weightings in the portfolio minus the weightings in the benchmark, since both must add up to 1, must add up to 0. Well, what is this term over here? This term is active weights. The sum of all the active weights must add up to 0. Okay, so the sum of all the active weights add up to 0. Great. I'm going step by step here. I want you to agree with everything I say so far. If you can't see that this is true, go back, rewind the video, and review what I just said here. Because it's important what I do now. So, I'm going to say the active return is the sum of the active weights. It's this term right here. See this term right here? All I'm saying is the active return equals that minus this term over here. But how can that be? How can we take active return equaling this term, but also equaling this term? The only way that that works is if this whole term adds up to 0. Well, the return on the benchmark, this is a constant, isn't it? That's a constant. So if the sum of the active weights adds up to 0, and this is a constant, this whole term equals 0, since the sum of the active weights equals 0, and the return on the benchmark is a constant. Well, what's the point of that? I mean, we already had this. Why are we adding this in? Well, because mathematically we can do little tricks, right? We haven't changed the active return by subtracting 0 from this. So we're still going to get, this will go to 0, we'll still get this. But now we can collect terms, and maybe we can say it a little differently, right? So let's collect terms. What's the common term in each? It's the active weight. So it will be, the active return is the sum of the product of the active weights multiplied by the difference between the return on the security minus the return on the benchmark. Well, what is this over here? This is active return per security. Active return per security. So the full active return is the active weights on each security multiplied by the active return on each security. Do you get that? The active return on each security. Now remember, this is the portfolio benchmark. Value added is the sum of the product of the active weights and the active security returns. Before we go on, I want to point your attention to this term. This is RB. This is the return on the benchmark. So let's think about what goes on here and the active weights. A weight can either be positive or negative, right? You can either weight something in your portfolio higher than the weighting in the benchmark, or you can weight something in your portfolio lower than the weighting in your benchmark. So let's say that this term is positive for a particular asset. Look at this term, the return on the particular asset minus the return on the benchmark. Under what condition would this be positive? The only condition that this would be positive if we're looking at the individual security and it had an individual return that was greater than the average of all the returns in the benchmark, which is the benchmark average, right? The benchmark return. So what this is saying is that active return comes from overweighting securities that will do better than the benchmark, and active return comes from underweighting securities that will underperform the benchmark. Because this term will be negative if we underweight, and this term will be negative if this underperforms, thereby adding to active return. So we can get active return in two ways. We can be overweight the outperformers, or we could be underweight the underperformers. Both add to active return. All right, so let's say that a little bit formally. Now, these are the equations that we developed on the last page. Active return is the sum of the active weights, the sum of the product, I should say, of the active weights on each security multiplied by the active return on each security. And expanding it out, the active return on each security we know was the return on the security minus the return on the benchmark. So I'm going to say what I just said on the last page, but in words here. Positive value is added under two conditions. Securities in which the return on the security is greater than the return on the benchmark are overweighted, and securities in which the return on the individual asset is less than the return on the benchmark are underweighted. If we overweight, this term will be positive, this term will be positive. If we underweight and this condition is true, this term will be negative, this term will be negative. Both these conditions, you need to see that both these conditions add to active return. So let's do an example, and I'm going to show you the wrong way to evaluate active return, and then I'm going to show you the right way. Now, if I just showed you the right way, you would say, but that doesn't sound very intuitive. That doesn't seem to make a lot of sense. Well, let's follow along. Let's say we have stocks and bonds, two asset classes. We're not going to worry about the individual securities in each, but let's just say that we have a portfolio of stocks and bonds and we combine them together. The benchmark combines them in the ratio of 60% stocks, 40% bonds. That's the weighting in the benchmark. The portfolio is 70-30. So that's the weighting in the benchmark and the weighting in the portfolio. So we can figure out the return on the benchmark. Here's our return on stocks was 14%. Our return on bonds was 2%. So the return on the benchmark is 60% times the stocks, plus we have a weighting of 40% times the return on bonds is 9.2. Return on the portfolio using its weightings and the return on stocks and bonds is 10.4. We can easily figure out active return as the return on the portfolio minus the benchmark is 1.2%. There we go. To what do we attribute that to? Here is the wrong way to do it. Here is a very naive way to do it. You could say, well, the return on the portfolio of stocks minus the return on the return on the benchmark of stocks was plus 1.4. Overweighting stocks in our portfolio returned 0.7 times 0.14, whereas the benchmark only had 0.6 times 0.14. So we made an extra 1.4% above the benchmark by overweighting stocks. However, if we look at bonds, the return on our portfolio for bonds minus the return on the benchmark for bonds, we had 0.3 times 0.02, whereas the benchmark had 0.4 times 0.02. So the benchmark had higher return from bonds. So the difference is negative 0.2%. From our perspective, from the portfolio perspective. So if we were just looking at this and you wanted to assess the manager on this, you'd say, okay, well, you outperformed the benchmark on bonds, you earned a higher return, on stocks. You generated an extra 1.4% return versus what the benchmark did on stocks, but you generated less of return than what the benchmark did on bonds. And there's your 1.2. So you would say, you did good on stocks, but not so well on bonds. Well, that's not true. That's not true at all. The portfolio manager would say, are you kidding? I outperformed on bonds. And you would say, well, how is that possible? If I multiply this 0.4 times 0.02, it's clearly a higher return number than 0.3 times 0.02. So you want to bring his attention to, yes, but listen, bonds really underperformed. I underweighted the underperforming asset. That's good. This is the condition for bonds. RI was less than RB, and I underweighted it. I win. And this is the condition for stocks. RI was greater than RB, and I overweighted. I won on both. You're telling me that I lost on one. That's not true. Here's the right way to do it. Take the return on stocks minus the return on the benchmark. That's RI minus RB. We've already proven that this is active return, right? Take the return on the stocks minus the return on the benchmarks times the weighting, the active weighting on stocks. Stocks returned 0.14, the benchmark returned 0.092, and we were overweight by 0.1. That added 0.0048, or 0.48%. So that added 0.48% to our return. For bonds, we take the return on the bonds minus the return on the benchmark. Notice this is always the benchmark, times the active weight on the bonds. Well, look what's going to happen in here. 0.02 minus 0.092. This, inside the brackets, is going to be a negative amount. Our weighting was underweighted. That's a negative amount, which means it turns into a positive for us. 0.0072 or 0.72%. You add them together, there's your 1.2%. When we look at it this way, we say this is a positive number, so you added value by your decision to overweight stocks. This is a positive value, so you added value by your decision to underweight bonds. So how do we add value? We overweight the securities we think will outperform the benchmark. We underweight the securities we think will underperform the benchmark. Both those things add value. That's sometimes hard to get your head around because students tend to run to this and say, aha, here's how it looks. But this is how it looks. Their manager won on both counts. All right, let's do a little bit of an extended example that's in the book, and let's have a look at a portfolio that's invested across different countries: United Kingdom, Japan, France, Germany, and other countries. The benchmark weights are 0.22, 0.21, 0.1, 0.09, and 0.38. The portfolio has changed the weightings. Notice the benchmark is 22% in UK, but the portfolio is only 16%. And other countries are the same. There's no active weight difference here, so there'll be no active return difference because they're both weighted identically. There'll be no active return here. But all the other four are weighted differently and they have different returns. So to determine what the active return is, let's figure out what our return on the benchmark is. So our return on the benchmark is we just take each of the benchmark weights and multiply it by the return. And that's what I've done here. You can verify that all of these are just the benchmark weight times this return plus the benchmark weight times this return, on and on and on. And the benchmark returned 23.117%. So when we look down this column, if the benchmark is 23.11%, what would add value? Well, this is 20%. So we should see that the portfolio underweighted this one if it wants to add value. Did it? 16 versus 22. That's a good decision. This is 27.3%. This had a return greater than the benchmark, so we should be overweight that. Are we? We're underweight that. That's a bad decision. Next one was 27.7 versus 23. We should be overweight that one. We're underweight that. Next is 32.4. We definitely should be overweight, and we definitely are overweight by a lot. That's a really good decision. And this one here, it doesn't really matter. It's 18.8 versus 23. We should be underweight, and we're equal weight. So you could say that also is a bad decision. It's not a negative decision because it doesn't take away, but it doesn't add to active value. So let's figure out what our active value is here. We know that it is the sum of this product. The active weights multiplied by the active return, and the active return is the return on each security minus the benchmark. So there we go. What is the active weight on the United Kingdom? 0.16 minus 0.22. It's a negative weighting. We underweighted, so we have a negative weighting. The next one is 0.14 minus 0.21, so that'll be 0.07, again an underweight. Here we have another underweight of negative 0.2, but here we're overweight by 0.15. And then we multiplied by these are all the RIs, these are all of these returns, and notice that this is the same all the way down because it's the benchmark return. So here we go. So we're looking for positive numbers. Our first entry is a positive number. So that means you did very well on that. You made the right decision. And what was the right decision? We were underweight an asset that underperformed the benchmark. That's the right decision. Here we got a negative sign. We made the wrong decision. So we can put an X here. Where did we go wrong? We were underweight an asset that outperformed the benchmark. Here we have another negative number. That was another wrong decision. Where did we go wrong here? Again, we were underweight another asset that outperformed. And here it's positive, significantly positive. I shouldn't say significantly as in the statistical sense, but let's say bigly. How's that? We'll use the new president's word. It's bigly. It's positive bigly. So that's a good decision. What did we do? We were really overweight a really big outperformer. That's a fantastic decision right there. If we add them all up, we get 0.01153 or 1.153% active return. We can verify that that's right by using a more simplified formula, which is just the active weights times the return on each security. This is the active weights multiplied by just the difference by the active return. Here we're just going to multiply it by the security return to show that. Remember, I made some efforts to show that by adding this in, we really were by subtracting it from the original formulation, where we were really subtracting 0. We started with this original formulation, and I said, but we can always subtract WIRB because that term equals 0. Well, let's find out if this actually equals this. So all we do is we just take the active weights, 0.16 minus 0.22, and multiply by the full return all the way down. And we have a negative sign, a negative sign, a negative sign, and a positive sign. So if we were looking at attributing performance or patting the investment manager on the back, we have a negative sign here would say, that's not good. You have a negative sign here, that's not good. Negative sign here, that's not good, but that's good. Again, you still get to 1.153%, but we're attributing the wrong things. We're saying here, you were right 1 out of 4 times, where in essence, he was right 2 out of 4 times, saying that you were right 25% of the time versus 50% of the time. So we can see that while this does get us an answer for active return, it really only gets us an answer. The process we go through and the output that we get is of no value, only the answer. We would like to get to the answer, but also have the output be of value. This output is of value, hence we would tend to use this derivation more than this, because this only gives us an answer. This gives us an answer and information. All right, here I may lose you a bit on screen 5, but I will get you back on screen 6. It'll all make sense once we go through a problem, and I'll show you how it all fits together nicely. But I'm going to give you these this messiness at the bottom of the screen, and I'll tell you what we're doing here. We're decomposing value added. We know that we can calculate what value added is. But is value added from a particular manager due to just asset class selection? Is it due to security selection within the asset classes? There's a little bit of both going on. Or maybe one was a good performer and the other one took away from it. So we're going to decompose value and attribute it to superior or inferior asset allocation, and that due to security selection. So remember our benchmark 60-40 stocks. Our portfolio was 70-30. So right away we see that we're overweight stocks in the portfolio and we're underweight bonds. And we saw that both of those decisions were good decisions. However, within the stocks, we may have specific securities that we selected that were over and undervalued there as well. Well, did those work out? And same with bonds. Did those work out? So we want to know how much was attributed to overall asset class selection, how much was attributed to security selection. In the example we did, we came up with an active return and we just said, well, it's 1.2%, there we go. And we knew that a certain amount was attributable to being overweight stocks and a certain amount was attributable to being underweight bonds. Well, that's just asset allocation. Now, if that's all we did was just change the weightings of the asset classes, well, then that's all we did. But what if we change the weightings of the asset classes and then change the weightings of the components in the asset class? Well, we want to break down that 1.2 and attribute it to, well, what are you good at? What are you bad at? So our total value added looks like this. Our active return is, and we've seen this before, it's the weighting. These are absolute weightings. Now, when we see the delta, that's active. The absolute weighting on each security. Well, there's only two asset classes here. M is the number of asset classes. So it would be the weighting, the absolute weighting in the portfolio of stocks times the return on the portfolio of stocks, plus the weighting in the portfolio of bonds, plus the return on bonds. That's easy to see. Minus, and this is the appropriate term for the benchmark. So this is the portfolio minus the benchmark, which is active return. We can write it a different way. This active return also equals this term. Notice that it's the return on the portfolio minus the return on the benchmark. If we're breaking it down into asset allocation and security selection, we want to attribute some to asset allocation plus some to security selection. Notice that we have a plus sign in here, not a negative. So what do we have over here? We have the active weight on each asset class multiplied by the return on the benchmark for each asset class. The active weight multiplied by the return on the benchmark. So that looks like this term here. What is this? We have stocks and bonds. So it's the active weighting on stocks multiplied by the return on the benchmark for stocks, plus the active weighting on bonds multiplied by the return on the benchmark for bonds. There's your asset allocation. Now we can stop right there. We don't even need this other term. We could just rewrite this a little bit. We could stop at asset allocation because RA, this gives us our total value added, and this gives us asset allocation. The difference must be security selection. And I want you to see that the difference, what we're writing down here, is the difference between this term and all of this. So what is security selection? It is the absolute weighting in the portfolio on stocks multiplied by just the active return on stocks, plus the absolute weighting on bonds multiplied by just the active return on bonds will give us security selection. These two terms will add up to what these two terms are subtracted. Let me show you in an example. Okay, I'm going to use a small example here to prove this to you, because if you don't intuitively see this, it becomes difficult to work with. Now, all you're left with is memorization, and memorization doesn't work. There's too much to memorize. You got to know it. So I said that this whole thing up here we could attribute to asset allocation, and the result from this we could attribute to security selection. So let me prove to you very intuitively that that's what I'm doing. I'm going to use an example. Now the book does not prove it to you with an example, which I find a shortcoming, but I'm going to go ahead and do it. And this is a contrived example. You're not going to find it in your books. I made it up. So let's say we have our stocks and bonds, we have our benchmark in our portfolio, and of course we're going to maintain the 60-40 weighting on the benchmark, the 70-30 weighting on the portfolio. But I'm making up returns now. Let's say for stocks, the benchmark did 15%, the portfolio did 17%, and for bonds, the benchmark did 4%, the portfolio did 4.2%. So we can figure out the return on the benchmark. That's easy. It's just weighting each asset class. 0.6 times 0.15 plus 0.4 times 0.04 is 10.6. So there's the return on the benchmark. Return on the portfolio, we would just use these weightings and these returns, and we'll get 13.16. Our active return is 2.56. We're done, right? But we want to know, what was it due to? How much was due to asset allocation, overweighting stocks and underweighting bonds? And how much was due to actual stock selection? Because we did return 17% on our stock portfolio and only 15% here. So we made something by security selection. Well, how much did we make? So let's start over here. Let's just ask a question. What if the benchmark were 70-30 as well? What if it wasn't 60-40, but what if it was 70-30? So let's do that. We'll take 0.7 times 0.15 plus 0.3 times 0.04 is 11.7. That's 11.7. Versus, what did it do? 0.6 times 0.15 plus 0.4 times 0.04 is 10.6. It would have done 11.7. It did 10.6. So there is 1.1% that could have been added purely by asset allocation. So of the 2.56, 1.1% we can say, well, that was due to asset allocation. Because if the benchmark did adopt those weightings, it would have been 1.1% higher. So of that 2.56, it must be asset allocation. Well, what have we done here? Here is our weightings of saying, well, let's weight it 70-30. Here's the original 60-40. If we subtract them, because we subtracted these two numbers, so let's subtract all the way along. 0.7 minus 0.6 is 0.1. 0.3 minus 0.4 is negative 0.1. Well, what is 0.1? That is the active weight on stocks. 60 to 70. So we're 10% overweight. So it's a positive 0.1 for the active weight. What is 0.15? That's the benchmark return on stocks. What is negative 0.1? That's the active weight on bonds. And what is 0.04? That's the return on the benchmark on bonds. All attributable to asset allocation, exactly what I did. So this is this term right here. If we go back to the last screen and look at the formula, this is this first term right here. This is the active weight on each security class, on each asset class, multiplied by the benchmark return on that asset class. That's all this is. All right. Now let's account for better performance. Here what we did was we weighted it the same way as the portfolio, 70-30, 70-30. But we only did 0.15 and 0.04. We're leaving out the extra 2% here and the extra 0.02. Once we add those in, we will have this whole term right here. Because we've got 0.7 times 0.15, we've already considered that. So let's just consider the difference, 0.7 times 0.02. And we have our 0.3, but we've already considered 0.04. Let's just consider the difference, 0.002. So this plus this, right? This here gives us 0.0146. So if we add 1.1 and we add 1.46, we get 2.56. There we go. What do we got here? 0.7. What is that? That is the absolute weighting in the portfolio for stocks. 0.02. What is that? That is the active return on stocks. If the benchmark did 15, the portfolio did 17, there's an active return of 0.02. What is 0.3? That is the absolute weighting on bonds. And what is 0.002? That is the active return on bonds. So of the 2.56%, we can say better asset allocation returned 1.1%. Better security selection returned 1.46% for total active return of 2.56. So we have a manager who can generate active return, who clearly knows how to choose the asset allocation weightings, and who can clearly, within each asset class, security select, pick the right securities. It didn't have to be this way. We could have returned 5% on asset allocation and lost 2.44 on security selection. In which case we would say, buddy, you need a partner. You need somebody who's really good at security selection because you're really good at asset selection. All right, let's use an example from the book. And let's say we have our actively managed fund and our benchmark return. And the fund weighted two particular assets. We own Fidelity and PIMCO in the fund in the weighting of 0.68 and 0.32. The benchmark is 0.6 and 0.4 on the weightings. Return 35.3 versus 32.3 and negative 1.9 versus negative 2. Value added for each one. This outperformed by 3. This lost 1.9 versus losing 2, so it was 0.1 better. Total value added, which is RA. This number over here is RA, is 4.8%. There's the return on the benchmark, and there's return on the portfolio. Let's verify that because these numbers are rounded off, and I don't want to round off to prove something in the end here. So the return on the portfolio is 0.68 times the return plus 0.32 times this return, and that'll give us 0.23396. It rounded off to 0.234 instead of 39. I'm going to leave it as 396. Return on the benchmark, all I'm doing is just verifying 0.6 times this return, 0.4 times this return gives me 0.1858, and it's 0.186. So I know how they got this number, and I know how they arrived at this number. It's just the weightings times the returns. Okay, great. I want to leave it in the full decimal form for now. Well, how much of the 4.8% can we attribute to asset allocation? Well, you'll remember for asset allocation, we're going to take the active weight times the return on the benchmark. So the active weight for the first fund, or for the first asset class, is positive. We're overweight, so it's 0.08 times the 32.23. And where are we here? From 0.4 down to 0.32, we're underweight, so we have a negative 0.08 times return on the benchmark 0.02, multiply it out, 2.744% of our 4.8 came from asset allocation. So we have superior asset allocation skills. What about security selection? Here, remember now we're going to use the portfolio weights times the active return. So our full portfolio weight is 0.68 and the active return is 3%, 0.03. The full portfolio weight here is 0.32. The active return is 0.01. Multiply that out, we get 2.072 or 2.07% positive or positive active return from security selection. Add the two together, we get 0.04816 or 4.816%. Compare that with the 4.8. Now keep in mind, I kept all my decimal decimal places down here and down here. So we could say that the 4.8 and 4.816 is the same, because notice that I kept my decimal points here. They rounded off. So clearly they rounded off. How's that? But I think that you can see that that's once we have it in our heads what we're doing, asset allocation versus security selection, that formula that we saw earlier that you may have looked at and said, oh, hey, wait a minute, how is this working? Why does it work this way? I think you know, or at least can see now, why it works that way. All right, so we've done A. A was to describe how value added by active management is measured. I think we get that now. Let's move on to B. Calculate and interpret the information ratio and contrast it to the Sharpe ratio. This is important, because once we get to the fundamental law, you have to have a firm understanding of what affects the information ratio and what affects the Sharpe ratio. So let's just take a few minutes here. Let's look at our Sharpe ratio. The Sharpe ratio is nothing more than the return on the portfolio minus the risk-free rate divided by the standard deviation of the portfolio. That's the returns on the portfolio. I'm going to eventually drop the RP and just put P, sub P. If you see me writing something like this or RP, it's the same thing. It's just the book is very formal with the RP, so I'm trying to play along. But eventually the book does drop it and I drop it too. So that's all that is. So the Sharpe ratio for the portfolio is the return on the portfolio minus the risk-free rate divided by the standard deviation of the returns. It's an absolute expected or realized reward risk measure. An absolute. For active management, remember, we have active return. So we can't really use an absolute measure for that, right? Sharpe ratio is unaffected by the addition of cash or leverage. Doesn't change the Sharpe ratio. So let's just do a small proof of that. Let WP be the weight on an actively managed portfolio, and 1 minus WP will be the weight on cash. So now we're going to add cash to the portfolio and see if it affects our return. So RC is the combined portfolio. RC is the return on the combined portfolio. And what is our return? It's going to be WP, the weight on the actively managed portfolio, times the return on the portfolio, plus 1 minus WP times RF, because it's the risk-free rate. We're investing in cash. So that is our return now. Well, if our Sharpe ratio combined is RC minus RF over the standard deviation RC, if that is our Sharpe ratio, well, RC equals all of this. So let's substitute that in, and we can expand that out. WPRP plus, we have RF minus WPRF, and of course minus RF, over, and we'll split this out. If we know that the risk-free rate, what's the standard deviation on the risk-free rate? It's 0. We know that it is 0. So to get the standard deviation for the portfolio combined, it's just the weighting on the actively managed portfolio times the standard deviation of the actively managed portfolio would give us this. So let's just break that out as well. Well, we can see we have plus RF minus RF, so they cancel out. So we have WPRP minus WPRF, and in our denominator we have WP times the standard deviation of the returns on the portfolio. Collect the terms on the top. WP gives us RP minus RF over WP times that standard deviation. We can see that these two cancel out. What are we left with? We're left with a Sharpe ratio. So adding cash or leverage will not change the Sharpe ratio at all. And we've seen that before, and I'm going to demonstrate a little later on that we've seen it. And, well, I'll give you a little hint now. Remember that this, from level 1, that's the optimal asset, and here's the risk-free rate, and we can either have a lending portfolio, we combine the optimal portfolio with cash, or we can have a leveraged portfolio. Well, there's cash, there's leverage, and the slope of this line is the Sharpe ratio. Notice it's unchanged. That's all this is saying, is the Sharpe ratio is unchanged by the addition of cash or leverage. Let's remember that. Let's move on. All right, let's get a couple examples behind us just to really press the point home about the addition of cash and leverage here. Let's say we have a return on a portfolio of 10.4% with volatility in those earnings of 17.3%, risk-free rate of 2.8%. Calculating a Sharpe ratio is fairly easy to do at that point, 0.4393. Well, what if we want to reduce the volatility from 17.3 down to 10%? To do that, you'll recall when we have our optimal portfolio and our allocation line, there's the optimal portfolio. We have this much risk, we have this much return. If we want to get down to this level of risk, we want to be here on the line, which means that's a lending portfolio. We're going to invest in a combination of the optimal risky asset and the risk-free asset. But notice the slope of the line remains the same. We're going to prove that now. So what weighting do we need on the portfolio? Well, we got to get to 10% out of 17.3. So 10% represents 57.8% of the volatility. So 57.8% of our portfolio will be in the risky asset. 1 minus that is 0.422. That'll be held in cash because cash has no volatility. It doesn't add to volatility. So let's just prove that that worked out. We need the combined return on this portfolio now. So the weighting on the portfolio, 0.578 times its return, 10.4, plus the weighting on cash times the risk-free rate, because we're invested in the risk-free asset, gives us 7.1928. Now we can do the Sharpe ratio for the combined portfolio. This is the return on the portfolio minus the risk-free rate over the standard deviation of the portfolio, which we know the full standard deviation is 0.173, but we've only weighted it by 0.578, right? Which we know is 10%, which gives us 43928, 4393. So let's find something that's, that's just nice, easy proof, but let's see how that can actually work in the real world where we can see that, oh, that's an interesting way to do things. Let's take large cap, small cap stocks, and let's say that we have an expected return on large caps of 10% and 13.4 for small caps. That is consistent with a higher equity risk premium for small cap stocks. Expected volatility of these returns, 15.2 versus 21.1. And the Sharpe ratio of 0.47 versus 0.5. Wow, looky. We would like to get this Sharpe ratio, but we don't want to live with this volatility. Is there a way to get this Sharpe ratio with that volatility? Wouldn't that be nice? Well, there is. Remember, the addition of cash or leverage to a portfolio does not change the Sharpe ratio. So we can change the volatility without changing the Sharpe ratio. So let's go ahead. We want 0.152 instead of 0.211. So we want 0.152 out of a total of 0.211. So 72.04% of our portfolio will be in small caps. The other 27.96 we'll put in cash. What's the return on that combined portfolio? The weighting on the portfolio times the return on the portfolio, 13.4. The weighting on cash times the return on cash, the risk-free rate, gives us a return of 0.1044. So the return on the portfolio minus the risk-free rate divided by the standard deviation of the portfolio, 0.5026, 0.50. Other than you can attribute that to rounding off. There, I think we've beaten the point to death. We understand that the Sharpe ratio is an absolute measure. We understand that the addition of cash or leverage does not change the Sharpe ratio. So to determine, to achieve some level of volatility, if we're targeting a level of risk that we want, we know we can take the optimal portfolio and combine it with the risk-free asset. We're going to see that when we move to active risk and we start adjusting the level of active risk and asking ourselves, is there an optimal level of active risk? There is, but we can't quite do it this way. So instead of a Sharpe ratio, we need something now called an information ratio, and it looks like the Sharpe ratio. The information ratio is, in the numerator, we have the return on the portfolio minus the return on the benchmark. Well, what is that numerator? We've seen that before. That's active return. In the denominator, we have the volatility of the active return. We have the volatility of the returns of the return on the portfolio minus the return on the benchmark. So that's the volatility of the active returns. So it's the returns, the active returns divided by the volatility of the active returns. Hence the information ratio is active return divided by active risk. So here's the property of the information ratio. Let's say that we have a passive fund that is identical to the benchmark. It's identical. So the Sharpe ratio of the fund will equal the Sharpe ratio of the benchmark. The information ratio will be 0. Why? Because there'll be no active return. There is no active positions. There is no active return. So the information ratio will be 0. So a fund that exactly replicates a benchmark will have identical Sharpe ratios, but an information ratio that is 0. If we take a market neutral fund, in other words, we have long positions and short positions such that the beta of the portfolio is 0. We're long a certain amount of beta and we're short a certain amount of beta, we get to 0. The risk-free asset also has a beta of 0. However, the market neutral fund is all active. It is all active. So if the risk-free asset is our benchmark with a beta of 0, we've got a beta of 0, but certainly nothing anywhere near there. It's all active. Hence, the Sharpe ratio on the portfolio will equal the information ratio on the portfolio because the return will all be active. The return on the portfolio will also be all of the active return. The information ratio is affected by cash and leverage. There's a problem. It is affected by cash and leverage, so we can't use it to construct portfolios that target a certain amount of risk by combining it with a risk-free asset, by combining it with cash. Cannot do that because it's affected by cash and leverage. Portfolio plus cash, information ratio drops. However, the information ratio is unaffected by the aggressiveness of the active weights. Let me correct my spelling here. By the aggressiveness of the active weights. What do I mean by that? Well, let's take a combined portfolio and let's here's the active weights. Well, let's multiply the active weights. Instead of let's say that this was 0.1. Well, let's multiply all the active weights by 2. So if we're overweight something, let's double it. If we're underweight something, let's double it. So just get more aggressive with the active weights. The information ratio is unaffected by that aggressiveness. The information ratio is affected by cash and leverage. The Sharpe ratio is not. The information ratio is unaffected by the active weights. So if we're going to adjust the active risk, how would we do it? We must do it through the active weights. If we have too much risk, well, then we're too overweight and too underweight. We got to pull it back. If we want to take on more risk, well, then we need to dial up our over and under weightings, right? So look what happens with this. Since this is a constant, it can come outside. What do we have in here? This is just this is just active return in here. So it's CRA, and the information ratio is CRA over C times the volatility, because if we double the active weight, you double the volatility. The C's cancel out. What are we left with? We're left with the information ratio equals this, thereby proving that the addition of aggressiveness will not affect the information ratio. That's the big difference you got to take away from the Sharpe ratio and from the information ratio. For the information ratio, if we're going to adjust active risk, we cannot do it by combining the portfolio with the risk-free asset, by combining it with cash. We can do it by combining the portfolio, the portfolio we have with the benchmark portfolio. But typically we would do it by adjusting the active weights. We would try to figure out, well, what is the optimal active weights we need to target a certain amount of risk? That is coming up. All right, so let me bring you back to level 1. I've alluded to this a few times, but this is what we've learned in level 1. We have some efficient frontier. This is from the furthest point forward. That's the Markowitz efficient frontier, and our optimal risky asset portfolio will lie along that frontier. Here's the risk-free rate and our risk-free asset, and if we draw a line tangent to the optimal portfolio, this line here has a slope of, well, we take the return on the portfolio minus the risk-free rate, that's rise over run, and run is the standard deviation of that return. That's our Sharpe ratio. So the slope of this line is our Sharpe ratio. Our investors might have different levels of risk aversion, which will lead them to either be in a borrowing portfolio, a leveraged portfolio, or a lending portfolio. Their Sharpe ratio remains the same, but they can target the level of risk that they want. Of course, they'll be modifying the level of return that they want. This is all fine for a passive fund or a passive strategy where you're going to hold a position in the optimal risky asset portfolio and the risk-free rate, and there you go. Risk return can be adjusted with either cash, a lending portfolio, or leverage, a borrowing portfolio. What about active investing? How do we target that? Is there an optimal amount of active risk? Adjusting active risk may involve investing in both the actively managed portfolio and the benchmark portfolio, but more likely modifying active weights. That's where we're headed. Just to let you know right now that what we're doing is we're going to get to a place where we say, okay, well then fine. If we want to target a certain level of active risk, how do we determine what the optimal active weights are? Once we do that, well, there's a few other little things we need to know, but I just let you know that that is where we're headed. Sometimes it's nice to have a roadmap. So we're headed towards that point now. Okay, let's set up a problem here, and we're going to try to solve it the wrong way, and you'll see why it's the wrong way, and then you'll appreciate the bigger solution that we get to. Let's say that we plot excess return versus volatility. So rather than having our optimal portfolio lie on the capital allocation line that's got the steepest slope intersecting with the risk-free rate, it intersects with 0 because this is just excess return now. And we know that the optimal portfolio is that portfolio which lies on the steepest capital allocation line, the capital market line. That is that'll give us the best return for risk, the one with the highest Sharpe ratio. There's our optimal portfolio, and let's say that it generates excess return of 8.7 for a standard with a standard deviation of 14.2. Here's the Sharpe ratio for the portfolio, 0.61. We know that any other portfolio will be below that, any other one. So any benchmark we choose that is not the optimal portfolio will have a Sharpe ratio that's below that. So there's our benchmark down there, and unfortunately our benchmark is our benchmark. As I said earlier, it could be a benchmark for a manager who is attempting to invest in nothing but biotech stocks. Well, it won't be the optimal portfolio, but it's still a valid benchmark. It'll have a lower Sharpe ratio, and here we have a 5% excess return with 10.8 on the volatility for a Sharpe ratio of 0.46. So we say, well, couldn't we beat any benchmark out there just by investing in the optimal portfolio and be done with it? Say, there we go. We can't do any better than the optimal portfolio. If all benchmarks are lower than that, why mess around? Why not just invest in the optimal portfolio? Well, because it has too much risk, perhaps. Perhaps your benchmark is such that you want large cap, dividend paying blue chip stocks that have a very low level of volatility. And that's what you want. The market portfolio, the optimal portfolio just isn't good enough for you. Now, we know we can adjust the risk of that by adding cash to it. But maybe we don't want to do that. So let's figure out how we can keep this Sharpe ratio and have the same risk as the benchmark. Now, typically what we could do is we could say, well, let's just extend up towards this line. There we go. So that is a lending portfolio. So we'll just combine the optimal portfolio with a certain amount of cash, and we'll achieve a higher return than the benchmark at that level of volatility. Here's the problem with that. Let's look over here. This is a property of active management theory. The Sharpe ratio of the portfolio squared equals the Sharpe ratio of the benchmark squared plus the information ratio squared. This implies that the active portfolio with the highest information ratio will have the highest Sharpe ratio. And we just said if you combine cash or leverage with an active portfolio, you lower the information ratio. So doing this, combining the optimal portfolio with a certain amount of cash to meet the volatility of the benchmark isn't going to be optimal. Isn't going to be optimal because we'll lower the information ratio, and the information ratio is our active return. It tells us it indicates a level of active return. So we're going to have to find a different way to do it. So we can ask a question about the optimal amount of active risk that we should have. And it is a function of the information ratio, and this is it here. This is the optimal amount of active risk. So we cannot combine it with cash, we know that. So we got to do something with the benchmark portfolio to bring it higher by being more aggressive with the weightings on the benchmark portfolio. So we'll take this benchmark portfolio, we'll overweight some things, we'll underweight some things, and we'll slowly walk it up to where we need it to be. Hopefully that's what we want to do. And we'll talk about this a little later, this 10.8. Right now we're just asking a question about the optimal amount of active risk. Later on, we'll constrain it. But right now, we're going to talk about something called unconstrained, okay? And it equals the information ratio divided by the Sharpe ratio, this line right here, the Sharpe ratio of the benchmark. So it's the information ratio divided by the Sharpe ratio of the benchmark multiplied by the volatility of the benchmark. And this optimal amount of active risk, it'll give us a level of risk which we would refer to as a level of aggressiveness that we can take on the weightings. Everything looks better with numbers. Let's do that. Okay, so if we're going to talk about active risk and the optimal amount of active risk, let's redraw our chart in terms of expected active return versus active risk. And of course you can have active return can either be positive or negative. This is zero active return. There's your benchmark. Remember the triangle was the benchmark. Well, the benchmark will have no active risk because it'll have no active return. These are individual assets that are in the benchmark. Individual assets are in the benchmark. And notice that some of the individual assets have a return above and some have a return below. That's the whole idea of the return on the benchmark, right? It represents basically a weighted average return of all the assets. So some will be above, some will be below. However, the optimal portfolio that we will construct, the optimal active portfolio, will have an information, the information ratio line. This is the optimal IR, will lie above all the other assets. So let's have a look at what that optimal information ratio should be. And it is equal to the expected active return divided by active risk, right? So you think about it as rise over run. And what's your rise? It's your expected actual return over your active risk. Remember this relationship. So the Sharpe ratio on the portfolio squared equals the Sharpe ratio on the benchmark squared plus the information ratio squared. Well, we knew on the optimal, on the last screen, remember the optimal risky portfolio had a Sharpe ratio of 0.61. The benchmark had a ratio of 0.46. So what is the optimal information ratio we need to achieve? Well, it's whatever satisfies this condition, right? IR squared. IR squared equals 0.61 squared minus 0.46 squared. So IR is the root of that, which is 0.400. So that is the optimal information ratio we need. From that, we can determine the optimal active risk. It is IR over the Sharpe ratio of the benchmark times the standard deviation of the returns on the benchmark. So let's just put it in, 0.4. We've already figured out what the optimal IR needs to be. Divided by 0.46 times 0.108 is 0.0939. So for risk, the optimal amount of risk is 0.0939. And if we have 0.0939 as our optimal risk, we know that the information ratio is the expected active return divided by active risk. Well, we already solved for our information ratio. We've already got our active risk. It's easy enough to solve for expected return. At this level, we would expect active return of 3.756. So here's the trick. Here's what we need to do. What we're saying is, look, we need to construct an active portfolio such that it has the highest level, or the highest information ratio. Because the highest information ratio will lead to the portfolio with the highest Sharpe ratio, which we know is the optimal risky asset portfolio. So we get to that level of information, we get to that information ratio. From there, we can determine what level of active risk we need. That level of active risk will determine what our active return will be. So, how do we get there? Weights on individual securities or asset classes can be adjusted to get the active risk to 9.39%. Number one, we can just adjust weights on the different securities or asset classes to get there. We're going to spend some time saying, well, how do we adjust those weights? Turns out there's a pretty straightforward way to do it. So we're going to do that next. Or we can simply combine the optimal portfolio with the benchmark portfolio. We can buy 70% of this and 30% of this to try to get the volatility to a level that we want, a desired level that we want. We'll spend one screen at the end doing that. Typically, this is the route that's taken is looking at optimal weights. All right, the groundwork has been laid. We're going to move on to some problems soon and look at some numbers. I know I promised a little while ago that we would, but a few more things that we had to get through. So we're done A and B. We know how value added is measured. We know the difference between the Sharpe ratio and the information ratio, and we know why we're paying attention to the information ratio on an actively managed portfolio and dealing with the weights of the portfolio, because as aggressive as we get with the weights, it won't change the information ratio, but the addition of cash or leverage will. So we know that our solution lies somewhere in taking care of those weights, right? So let's start C. This one is a little bit lengthy. State and interpret the fundamental law of active portfolio management, including its component terms. Transfer coefficient, information coefficient, breadth, and active risk. Honestly, these are really, really straightforward things that once I show you how it's done, it's like, is that it? Is that all it means? That's all it means. So let's go. And I'm going to lead you through it step by step. I'm going to assume nothing here. The investor, or any investor, is concerned about maximizing the managed portfolio's active return, subject to a limit on active risk. That's a big statement. I want to maximize the active return I get above the benchmark because, hey, I'm paying fees for active management, so I want to maximize that. But look, don't go crazy. Subject to some limit on active risk. That limit on active risk, by the way, whatever we set it at, that's called the benchmark tracking risk. So we'll be within some sort of tracking risk of the benchmark. And so that'll come up a little later on. Investor forecasts now. Let's deal with this. This is there are two ways that we can determine what we think an asset will perform like over a given time horizon. We can use some sort of return generating model and plug in all the, whether it's a 2-factor, 3-factor, 4-factor model, plug in everything into that model based on their sensitivities and let the model tell us what the expected return on that asset will be, and then choose the ones with the highest one. That has nothing to do with us. That's an important distinction now. If we're just using a return generating model to tell us what to do, that has nothing to do with our ability to pick stocks. That has to do with our ability to choose a model that can pick stocks. That's all it has to do with. So we cannot attribute the success of that to me as the manager, because all I did was I ran a model and my portfolio was entirely model driven, period. So anybody, a computer can do that, not me. So for me to claim success, I must say, look, I came up with these values myself. I decided which assets would outperform and which would underperform, which is why we need the investor forecasts, subjective forecasts. And we'll see why in a minute, but we'll need those forecasts. And what are we forecasting? We're forecasting the active return. My forecast from active return is I would look at the return that I expect on the asset versus the return I expect on the benchmark, and I'll have some forecast of active return for n individual assets. I'll go through all of them. Well, we're going to let mu I stand in for the investor's subjective expectation of the active return on asset I. That's important now. This is the investor's subjective expectation. It's not the output of running a capital asset model or a three-factor model and just ranking them in their output. That has nothing to do with our ability, all right? So rather than using this terminology anymore, so the expected value of the active return, we're going to call mu I, and we're going to say that, well, when we see mu I, what that means is it means the expected return from a subjective point of view to distinguish it from purely a model-driven aspect. All right? Great. So let's look at this triangle because this helps us put everything in the focus. So up here, I have the forecasted active returns based on subjective expectations. Here's the manager's forecast for what they think is going to happen. Down here, here's what actually did happen. These are realized active returns. This is what they thought would happen. This is what really happened. So the correlation between these two is referred to as the information coefficient, called signal quality, the information coefficient. It tells us how good this correlation between these two tells us how good a manager is on their forecasts compared to what actually happened. And correlations, we know, go from -1 all the way up to 1. So a manager with 0 correlation shouldn't even be in the business, right? So the higher the information coefficient, the better the manager. That's why we took some time to say it must be the subjective expectation, because if all the forecasts were just a three-factor model, well, the information coefficient would refer to the model and not to the manager. All right, so here we go. Mu I that's a human being up there, and there's a correlation here which we refer to as the information coefficient. Well, what do we have along the bottom here? These are realized returns. These are active weights. These are the active weights. So the active weights may be positive or may be negative, may be overweighted, may be underweighted. And the return, the realized return, may be positive or negative. What we'd like to see is we would like positive active weights when we have positive realized active returns and negative active weights when there are negative realized active returns, because both of those add to value. So this measures value added. And the correlation between here measures the value added. And what do we have over here? Well, we know that this is the subjective forecasts. These are the active weights. And the transfer coefficient measures the correlation between the forecasts and the active weights. Well, what is that? What's going on there? What could that possibly measure? Well, it's called the transfer coefficient, and here's what it is. If you have an unconstrained portfolio, in other words, there's nothing stopping me from doing what I want to do, I have no constraints on my actions, the transfer coefficient will be 1. Because all of my forecasts can be transferred directly into the active weights. I'll lose nothing because of constraints. If I want to overweight something, I'll overweight it. If I want to underweight something, I'll underweight it. If I really want to overweight, I'll really overweight. So the correlation here will be 1 because I'll do exactly what I want to do. But in a world that we live in, we have constraints. You can't always do what you want to do. The transfer coefficient measures the correlation between what I want to do and what I really can do. So if I'm dialed back quite a bit, clearly I'm not going to reach all the goals that I really want to reach, right? So we'll see where the transfer coefficient comes in later on. It comes in right at the very end. But we're going to deal with this leg right here first. We're going to deal with this leg, and then we're going to deal with this leg. All right, so I really want to drive this point home about what each of these legs are measuring. So let's start along the bottom. I said that that was value added. And here's what we want. Here's a good situation. Here's a bad situation. we want to have positive active weights. I don't have the deltas in front of these, but just go ahead and stick deltas in. We want to have positive active weights when we have positive active returns, and we want to have negative active weights when we have negative active returns. What's bad is to have positive active weights when there's negative returns and negative weights when there's positive returns. So what we would like is, if we're going to have negative returns, we would like negative weights. We would like to see something like this. There we go. So if we wanted to, measure the line of best fit through here, what are we coming up with? We're coming up with a correlation. And what correlation is that? That's the correlation between the active weights and the active returns. That measures value added. The higher this correlation, the more there is a relationship between positive weights and positive returns and negative weights and negative returns. What we don't want is to start seeing stuff like this all over the place, because then the correlation almost goes to zero. So that's what this bottom part measures, is this correlation. Well, what does this measure over here? This is our forecast. This is the manager's forecast. This is what actually happened. We would like a situation where, if the forecast was negative, the realized return was actually negative. If the forecast was positive, the realized return was actually positive. So we'd like to see some kind of relationship that looks like this over time. If we thought it would return a certain amount positive, it returned that amount positive. We thought negative 10%, if we thought negative 10, it returned negative 10. So the closer we are to a 45-degree line, the more we know that we are doing the right thing. And of course, there'll be a correlation between those two. So this is measuring the correlation between the manager's forecasts and the actual returns. This is called the information coefficient. It's capturing forecasting ability. And what is this leg measuring over here? This is going to measure clearly the correlation between forecasting ability and the ability to actually transfer it into action. So what we'd like to see is, if we're forecasting negative active returns, we would like negative weights. And the less negative it is, the less negative that is. If we think that we're going to have positive active returns, the more positive we are, the more aggressive we want to be. So we should end up with, again, something that kind of looks like this in a perfect world. Now, correlations are never this great, but we should end up with something that looks like that. So if we have high information coefficient, if you have a high transfer coefficient, meaning that those forecasts can actually end up in weights, the higher the information coefficient, the higher the value added. That's basically what we're getting at with the fundamental law. But we're going to state the fundamental law in terms of the information coefficient and the transfer coefficient. So remember IC and TC, we're going to use them in a formula. All right, so our goal is to figure out, well, what are the optimal weights that we would assign to each of the individual assets? How do we figure out what those optimal weights are? And it turns out it's this big ugly thing that we're looking at here. And this notation here with the star, every time we see a star, it means it's based on optimal weights. It's the mean variance optimal active security weights for uncorrelated active returns subject to a limit on active risk. There's the limit on our active risk right there. So let's break down in this and see what we have. What is the numerator here? Mu. We know it's our forecast, a subjective forecast of active return. That's what we believe the active return will be. So the higher the active return that we think we can get, the greater the weight. The lower the active return, the lower the weight. And active return is divided by the variance of that particular asset. So the more volatile that particular asset, well, then we don't get that aggressive with the weighting, because yeah, you got a big weight, but you also got a big risk, right? And this is the constraint that we have. This is the limit to active risk. And if we look at this term, and you look at this term in here, this is the sum of all of that. So we have so much risk that has to go around to all of this thing, and this is each individual one. This is the best way that I can explain it without going into too much detail. Well, this is just hard and difficult to work with. We don't want to work with summations. We'd rather deal with something nice and simple. So we're going to simplify here. Let's let our subjective estimate or forecast of active returns, mu I, equal IC times sigma I times SI. Well, what are all these things? Well, we know what the information coefficient is. We know it's the correlation between our forecast of active return and the realized active return. That'll be positive. That IC will be positive because if it's 0, means we have no skill. If it's less than 0, means we're actually destroying value. We wouldn't even be in the industry, so that'll be positive. Risk is always positive. There's no such thing as negative risk. Risk is either 0 or positive. So SI has to be there in order to keep this term positive or make this term negative, because we might forecast negative active return. We might look at a particular asset compared to the benchmark return. We might say it'll underperform. So its active return will be negative. Well, how do we get this term negative if IC is positive and sigma I is positive? You need the score. Here's how the score works. It works based on categories of overperformance, neutral, and underperformance. So let's say this is the 3 categories we had and that was it. We're going to make no distinction about overperformance. Just it's either an overperform, a neutral, or an underperform. What we would do is we would score an overperforming stock with a 1. We would score a neutral stock with a 0 and an underperforming stock with a -1. So the 1 preserves the positive sign, which means that we're forecasting positive active return, hence overperformance. Otherwise, we wouldn't be forecasting positive active return if we didn't think overperformance, right? Well, if we're forecasting underperformance, since this is positive and this is positive, we need some way to make this negative. We score this as a -1, and it turns that term negative. Now, this is just one example of a scoring system. The important thing of the scoring system, it must satisfy 2 properties. The sum of all the scores must add up to 0. So -1 plus 0 plus 1 equals 0. And the variance, the standard deviation, well, the variance, let me put that in correctly. The variance, you could have said the standard deviation as well because it's 1. Variance equals 1. So every score is one apart. So if I had outperformance in terms of really outperform, neutral, underperform, and really underperform, here's really outperform, here's outperform, here's neutral, here's underperform, here's really underperform. The sum of all the scores adds to 0, and the variance is still 1. And then, of course, your score would go in there. So really, it's just meant to scale the return, the active return, in terms of do we keep it positive or do we turn it negative. That's all that's there for. We'll see a little bit of that later on. So we can simplify this whole expression over here into this expression down here. So the first term we keep. All we're doing is we're substituting this term in here and simplifying. The algebra is a little bit more difficult. Let's just take it for what it is. So the numerator stays the same, but the denominator simplifies. IC and the square root of BR. Well, we've seen IC before. We know that's the information coefficient. That's the correlation between the active returns adjusted for its risk and the forecasts of active return adjusted for its risk. Why are we adjusting for risk? Because we can't assume that the standard deviation of the actual returns equals the standard deviation of the forecasted returns. If we could assume that the standard deviation of both were equal, we wouldn't have to risk adjust the correlation. But we risk adjust it so that we're capturing the right correlation. What's this BR business? That's called breadth. Roughly equal to the square root of n, n being the number of securities. Now I say roughly equal to that. It's not quite. Under certain conditions it is n. Under other conditions it could be more or less than n. So more accurately, it's the number of independent decisions made per year in constructing the portfolio. So if we got 10 securities and we make our forecasts at the beginning of the year and we set our weights and we let it run for the year, breadth is 10. But if we revisit our forecasts every 6 months, well, we make 10 forecasts at the beginning of the year, It says here the number of independent decisions. Then 6 months later, we do it again. Independent of the first 10, we make another 10 forecasts and see what that is. Our N would be, our breadth, our BR would be 20 and not just 10 securities. It would be the number of independent decisions, not just the number of securities. But for simplifying purposes, for this reading, we're just assuming that breadth is going to equal the number of securities in the portfolio, square root of N. So this is a nice, easy thing to work with, and this will get us our optimal weights. So let's move on and see what happens next. All right. Let's say we're looking at 4 securities, and here's the volatility of those securities, 25%, 50%, 25, and 50. And we have our scores of 1, 1, -1, -1. So what do these scores mean? Well, we have a score of 1 on security 1 and 2, so we expect outperformance. We have a score of -1 on the other 2, so we expect underperformance. If we expected neutrality, we'd score them 0. So our 3 scores are 1, 0, and -1. We have 2 outperformed, 2 underperformed. There we go. And we're going to assume an information coefficient of 0.2. So our manager has an information coefficient of 0.2. And that could be based on a forecast of what we think, or more typically, historical results based on how that manager has done in the past. He'll have a certain IC score that we can look at. All right. Number 1, a forecasted active returns. The expected active returns, remember we said is mu I. We're going to let that stand in for the forecasted active returns, but we also said that mu I is equal to the information coefficient multiplied by the standard deviation of the particular asset multiplied by the score. So we said let the information coefficient equal 0.2. That's a constant, so we have 0.2. Here's the first asset, volatility of 0.25, and we're going to score it with a 1. There's 5%. So that is our estimate of active return. Let's see how we got that. We're saying that we have an information coefficient of 0.2. That means the correlation between our forecasts and what actually happens is 0.2. You can think of that as being 20% right if you want, but it's 0.2. Here is the volatility of this particular stock, and here's our score. We expect it to outperform. So we take the volatility of that particular stock, and remember there's a correlation between risk and return. The greater the risk, the greater the return. So if it's got a volatility of 0.25, we got a correlation of 0.2. We multiply them together, and since we expect outperformance, we want to keep the sign. We multiply it by 1. Let's go to the next one. 0.2 times 0.5, and of course we want to keep the sign. 10%. That's our estimate of what the expected return is going to be based on what its risk is and how good we are. The next one, we have 0.2 multiplied by 0.25, but we're going to multiply by -1 because we think it's going to underperform. We get a return, or a forecasted return, of -5%, and then the last one, -10%. So we have now forecasted our active returns, and what did we need to do that? We needed to know what level of risk each asset had. We needed to know how good we are, and some level of some way to measure whether we are outperforming, underperforming, or being neutral on the stock. There we go. Number 2, active returns are uncorrelated. That's an assumption we keep making, that the active returns are uncorrelated. Independent forecasts are made each year. So if the active returns are uncorrelated, we don't have to worry about figuring out any correlations. If we make independent forecasts each year, we have 4 securities, means our BR, our breadth, equals 4. If we said independent forecasts are made twice a year, our breadth would be 8. So our breadth is 4. Now, our goal is to maximize our expected active return subject to active risk being equal to 9%. So there's our goal right there. That's what we want to do. So to do that, we need to calculate our weights. Okay, we have security 1, 2, 3, 4. We forecast these particular returns, and we're told, all right, maximize your expected active return subject to active risk equaling 9%. So to do that, we need to calculate our weights on these securities to make sure we don't exceed 9%. So the weighting on the first one, we gave this formula on the last page, weighting on the first one, I've rewritten it here, is our forecast for the first stock. Our forecast is 0.05 divided by the variance. The volatility is 0.25, that's a standard deviation, so divided by 0.25 squared, multiplied by the active risk that we're taking on, 0.09, divided by IC, multiplied by the square root of BR. Our information coefficient, we're told, is 0.2. BR, we're told, is 4. We figured that out. The square root of that is 2, equals 0.18. That is our weight on security 1. And to be more precise, that is our active weight on security 1, the active weight. For security 2, we do the same thing. What is our forecasted return? 10% divided by its standard deviation squared, multiplied by the next term. Now, you'll notice that this term will always be a constant. It will always be a constant. Once we have our constraint on our active risk, once we know our information coefficient and our breadth, this term will just be a constant. So we could just put that constant all the way in. And what changes? It's just our forecast of active return divided by the variance. Forecast of active return divided by the variance. Forecast of active return divided by the variance. That's it. So on the first security, we're going to overweight it by 0.18. So if it were already weighted in the benchmark at 0.2, we would be weighting it at 0.38. The next one, we're going to weight it by another 9%. The third one, underweighted by 18%. The fourth one, underweighted by 9. This should sum to 0. 18 plus 9 minus 18 minus 9 equals 0. The sum of the active weights should equal 0, and the sum of the active weights equals 0. All right, so let's start working our way towards being able to state the fundamental law. The first thing we're going to do is state the basic fundamental law. The basic fundamental law. And remember, I said we're going to work with one leg first, then we're going to go to the other leg of the triangle. So we're on one leg here. The basic fundamental law. The expected active return, this is optimal now, the expected optimal active return is equal to the information coefficient multiplied by the square root of breadth times our active risk. It simplifies to this. The star here indicates the use of optimal active security weights in arriving at this. We're going to make a distinction now, because remember now, we might not be able to put those active weights into play. So we want some way to determine whether or not what we're forecasting is by using the active weights or by using more constrained weights. So this is saying if we get to use the weights we want to use, this is the expected active return that we should get. So the optimal expected active return is a positive function of our forecasting ability, the breadth, and active risk. That's exactly what this is saying. Optimal expected active return is a positive function of, well, the first one should be obvious, right? Your forecasting ability. Well, yeah. Breadth and active risk. So you'll recall our information ratio was the expected active return divided by active risk. That gave us an information ratio, right? So the optimal information ratio, look over here. This is expected return. This is optimal. This is the use of optimal expected return equals all of this. So we can substitute that into the information ratio as the numerator here. Well, looky. These two things cancel. So the information ratio using optimal weights is equal to IC multiplied by the square root of BR. Thus, we can say that the expected active return using optimal weights is equal to the information ratio using optimal weights multiplied by the active risk. Look how simple that becomes. Look how nice and simple that becomes. So, that's kind of messy. Getting there was kind of messy. Only working through problems do we actually put some structure in our mind about what this looks like. So let's revisit what we did and let's see how easy it is to get to what we're trying to say here. Security 1, 2, 3, 4. We already figured out what active weights we wanted, 0.18, 0.09, negative 0.18, and negative 0.09. These are the optimal active weights. we would like to use these optimal active weights. This is our forecast of active return. 0.05, 0.1, negative 0.05, negative 1. We have a positive active weight where we have a positive forecasted active return, and we have a negative active weight where we have a forecasted negative active return. All these are consistent. Let's say the weighting in the benchmark of security 1, 2, 3, 4, it was equally weighted 25, 25, 25, 25. Here's how we construct our portfolio. We weight the first asset 43%. We weight the second asset at 34%, active weight of 0.09 on top of the 25. The third asset we only weight at 7%, and the last asset we only weight at 16%. So what is the return, the expected return on the portfolio? It is our active return plus the expected return on the portfolio, and we're going to have to recall from a few screens back when we introduced this, what the expected return on this portfolio was 10%. So we take the 10 and we add the 5, we get 15. We take the 10 and we add the 10, we get 20. We take the 10 and we add the negative 5, we just have 0.05, and we take the 10, add the negative 10, we get 0. So the expected return on the portfolio. Now that we have our weightings and our portfolio, our expected return is going to be 0.43 times 0.15 plus 0.34 times 2 plus 0.07 times 0.05, and we can stop there because that's 0, but we'll just put it in to show that it's 0. We get 13.6. 13.6 minus 10% equals 3.6. There's our expected active return is 3.6. Using unconstrained, this is an unconstrained portfolio in the sense that we can use the weights that we want to use. We can also figure out expected return another way. Expected return is the active weight multiplied by the active return plus the active weight, active return. Now notice it's minus minus, so that actually adds, and then minus minus, that actually adds. These are right decisions. Underweight a loser, underweight a loser, overweight a winner. We still get the 3.6 no matter which way you go. We get the 3.6. All right, so let's just continue on with the example we're on. We're doing a lot of work, but in the end I'm going to show you a really quick way. So we did all of this, figured out what the weighting on the benchmark was, used our active weights, adjusted our portfolio weights, figured out what the return on the benchmark was, added our active return, figured out our return on the portfolio, and then we figured out what the expected return on the portfolio was. We knew what the expected return on the benchmark was. We were able to get our active return. And this here, let's just test to make sure. We said that we would stick with an active risk of 9%. Let's make sure we did this. So we just take our weightings multiplied by the variance of each of the assets we have. And if we take the square, we square all of that. But if we take the square root of it, we'll get the standard deviation, which is our measure of risk. We get the 0.09. So we can see that we're well in line. We didn't have to go through all that. If we had used the basic fundamental law, it looks like this. The expected active return is the information coefficient multiplied by the breadth multiplied by the active risk. Now the active risk, we're saying, look, we're going to constrain it to a certain number, subject to a limit on active risk. We know what that'll be. The breadth, well, we said we would just use n. N in this case is 4, so that's root 2. And then our information coefficient, we were told it was 0.2. But the IC times the breadth also gives us our information ratio. Instead of an information coefficient, we have an information ratio using optimal weights. So the expected active return using optimal weights is the information ratio using optimal weights multiplied by the active risk. So all we have to do is just enter in what we know. We didn't have to do any of this stuff. We knew we were dealing with a manager that had an information coefficient of 0.2. There were 4 securities. We take the square root of 4. And we put a limit on active risk of 0.09. Multiply that out. What do we get? 3.6. What was our active risk going the really long way? 3.6. All that we did for learning objective C. I could have just given this to you on the first screen, said, here's how we figure out our expected level of active risk this way. But you wouldn't have appreciated and understood all the components. Now we do. So that whole route we took to get to the expected return on the portfolio, subtract the benchmark to get the active return, we had to figure out our weights and all our returns, multiply them out. Turns out it was 3 terms that we needed. IC, BR, and sigma A. There we go. And we would have gotten to the same 3.6. All right, let's move to the full fundamental law. And the full fundamental law, we have to bring in the transfer coefficient. And you recall that that was the correlation between what we forecasted and the actual weights we get to use. What we forecast, whatever our forecast of actual return is used to determine what the optimal weights would be. So we could also say that the transfer coefficient is the correlation between the optimal weights we would like to use and the actual weights we can use. When we talk about optimal weights, we're talking about, if we can use optimal weights, we're talking about an unconstrained portfolio. Nothing is constraining us from using those weights. So our correlation would be 1 for an unconstrained portfolio. But in the real world, most portfolios are constrained, so that the actual weights will not equal the optimal weights. So let me give you some examples of where that would happen. Some pretty obvious ones. A position limit. Perhaps you identify one stock you think is going to produce a lot of active return, and the optimal weight on it is 11%, and the benchmark has it at 4. But in your investment policy statement, you might have position limits that say no one position can exceed 6%. Well, you're not going to 11 then. You can go from 4 to 6. That's about the most you can do. You may identify 3 stocks that'll really outperform, but those 3 stocks are traded on an exchange in a particular country, and you might have a country limit. So you can't weight them all the way you want. So there's a lot of different restrictions. An optimal weight might call for a negative weighting on a particular stock. In other words, go short. You might be constrained to be long only, so the most you can do is 0 in that case. So what you'd like to do versus what you can do, the lower the correlation, the lower the transfer coefficient, obviously, right? Now, I said this before, but I've written it down here just to be clear. If we assume all individual securities have the same standard deviation, then correlations do not have to be risk-adjusted or risk-weighted. All right. So we had gotten to the full the basic fundamental law earlier was this, 3 terms. Well, guess what? To get to the full fundamental law, we're just going to multiply it also by the transfer coefficient. So what are we saying here? This is the expected active return. The higher the transfer coefficient, the higher the expected active return. The more we can take on the optimal weights that we want, the higher the expected active return. That's what the transfer coefficient is telling us. The information coefficient is the manager's ability to forecast correctly. The higher their ability to forecast correctly, the higher the expected active returns. Breadth is a little bit tricky to explain, so let me try here. If you have more assets, you'll recall that you can diversify away non-systematic risk, and all you're left with is systematic risk. But more importantly is this, revisiting your forecasts. The more often you revisit them, the sooner you can take corrective action. So the higher the breadth, the higher the expected active return, because that's active management, right? If you're just going to take your positions at the beginning of the year and leave them, that's not really active anymore. And of course, the higher the risk you're allowed to take on, the higher the active risk, the higher the expected active return. That makes a lot of sense. That's called the full fundamental law. The information ratio before we said was equal to this. Well, if we stick TC in front, we get the information ratio for the full fundamental law. To see that this is what this equals, remember the information ratio was the expected active return over active risk. Well, if all of this is expected active return, let's stick that in the numerator over active risk, and notice these two cancel out, so your information ratio is the multiplication of those 3 things. So we can see that the expected return is our information ratio, equals our information ratio multiplied by risk, because all of this is all of this, right? Nice and simple, isn't it? Look how neatly that comes together. All right, well, let's walk through a problem then. Let's see it all in action. How does this work? Security 1, 2, 3, 4. Remember that we had our estimate, our expected active return, 5%, 10%, -5, -10. And we had the standard deviation of each of these assets, the standard deviation or the risk, the active risk of each security, 25%, 50%, 25, and 50. So our optimal active weights, we said, were 18%, 9%, -18, and -9. These are active weights, optimal. However, we have a constrained portfolio, and this is the best we can do. You can't add 18%, you can only add 6. You can't add 9, you can only add 4. You can't go short, you can't drop it by 18. It has to be up by 7, and you can't drop this one by 9. It'll drop by 17. So this is what we actually can do. This is what we'd like to do. This is what we actually can do. Again, we're subject to an active risk constraint of 9%. That sigma A is 9%. So what's the transfer coefficient? We got to figure that out. Remember, we need 4 things now, right? We need a transfer coefficient, we need an information coefficient, we need breadth, and we already have sigma A. So we got that. So let's go ahead and see what we have. We got to figure out a transfer coefficient. We know that's the correlation between the forecasts and the actual weights. We can also say that it's the correlation between the weights we would like to take on versus the actual weights. But to figure out a correlation, we got to have pairs of numbers, and then you could use your calculator to figure out correlation, or use Excel or whatever. But let's just figure out the pairs we have first. What is the mu I over sigma I? Well, it's 5% over 25%. 0.5 over 0.25 is 0.2. And then we have 0.1 over 0.5, which is 0.2. Negative 0.05 over 0.25 is negative 0.2 and negative 0.2 on this first part of the pair. The second of the pair is the actual weight multiplied by the sigma I. So it's 0.06 times 0.25, 0.04 times 0.5, etc. So if we enter in these pairs into a calculator or into Excel, it'll give us a correlation, and it turns out that the correlation is 0.58. We're not going to go through that. On the on any exam, you're not going to be expected to calculate the transfer coefficient. You'll be given the transfer coefficient. You just have to understand that, the transfer coefficient is the difference between fantasy and reality, what we'd like to do and what we can do. 0.58. So if we plot these, just to give you an idea, this is 0.2. Here is the first of the pair. Here's the second of the pair. So we have 0.2 versus 0.015, there's that point. 0.2 versus 0.02, and then these two plot over here. Line of best fit looks like this. 0.58. Our transfer coefficient is 0.58 versus 1. If we could use the optimal active weights, would have a transfer coefficient of 1. So what's that going to do to the expected active return? Knowing that we've dropped from 1, our constraints brought our transfer coefficient down to 0.58. It's going to lower our expected active return. The more constraining the investment policy statement is concerning the active weights we can take on, the less ability we have to generate active return. All right, so we got TC and we've got sigma A. We need 2 more variables. Number 2, what's the optimal expected return? Remember, we said it was 3.6. We want to make sure we get to that 3.6. We said it was 3.6, and we know that our optimal active risk is 9%. So our expected return, 0.06. This is the actual weights now, times 0.05 plus 0.04 times 1. We just multiply it out. We get to 2.1 with an active risk of 9%. Let's find out if we actually get to 2.1 using our fundamental law. If we could just skip all of this stuff, right? Well, what's our TC? 0.58. What was the information coefficient of our manager? We said it was 0.2. Bread, we have 4 securities, the square root of 0.4, square root of 4, and our active risk was 0.09. We get 2.088. This is 2.1. The reason I did this step here is so that once we did this step, we could verify that we can have faith in this, that we can have faith. So if you do it the long way or you do it the short way, you'll get to the same thing. So let us restate this fundamental law so that we absolutely understand what it means in terms of active returns. The more unconstrained we are in taking weights, the better we can generate active return. The more constrained we are, the harder it is to generate active return. The better we are at forecasting, the higher the active return we can generate. The less better we are, the lower the return. The greater the breadth, the greater the benefits of diversification, and if we're revisiting our forecasts every quarter or every 6 months, that allows us to take more active management to stop problems or to push our winners. So that will also add to active risk. And of course, the higher the level of risk we can take on, the higher the expected active risk. So what we, as a manager, if we're hiring a manager, we don't want to constrain them too much on the weights that they can take. We certainly want to hire somebody with a high IC. We want to make sure that the number of securities that they're selecting is large enough, but not too large that they lose control. And maybe we have some policy of revisiting their forecasts every 6 months as opposed to every year. Maybe there's reassessing and rebalancing every 6 months. And we set a level of active risk that the portfolio is comfortable with. And that level of active risk obviously is going to constrain the return. You can't blame the manager for that. Now, if we were a manager with a good information coefficient, would we take on a fund that highly constrains us in the weightings that we can take on? The investment policy is written in such a way that we're really constrained here and they're really dialing back on the risk. How much active risk can we add if those two things are going on? Do you see all of the insight that you can get from these 4 little variables? Once we understand what all these correlations and what all these things are measuring, we see that it gets us to the same place as going through all of this kind of stuff. That's the power of this. Isn't that great? Well, earlier in this reading, we talked about the ways to modify the actively managed portfolio to bring it within a certain active risk constraint, and we modified the weights. But I said you could also combine the actively managed portfolio with the benchmark, much like you could combine the optimal risky asset portfolio with the risk-free asset to choose the risk level that you want. So that's what we're going to do. But to do this, we have to introduce the transfer coefficient into the calculation of the optimal amount of active risk. You'll recall the optimal amount of active risk was just this term over here. All of this. Now I've got the asterisk on top of IR to say that this IR is calculated as an unconstrained information ratio. If the transfer coefficient is 1, meaning yes, there are no constraints, then our calculation of the optimal amount of active risk is the same as it's always been. But the transfer coefficient will then tell us, hey, settle down. We have some rules that you have to follow here, and it'll dial back anything less than 1. As soon as you introduce any constraints, if this transfer coefficient drops anything below 1, the amount of allowable active risk that you can take on clearly drops. So that's the optimal amount of active risk. You'll recall that the optimal amount of active risk for an unconstrained portfolio was just the information ratio divided by the Sharpe ratio of the benchmark multiplied by the standard deviation of the benchmark. Here we stick the transfer coefficient in front to say if the portfolio is unconstrained, you can put transfer coefficient in here, it would just equal 1. Any constraints start to lower that, you're going to have lower active risk. And of course, we said that in an unconstrained portfolio, the Sharpe ratio of the portfolio squared has a relationship to the Sharpe ratio of the benchmark plus the information ratio. And since these two are given, our job is to try to, well, there's not so much given, but we know what the Sharpe ratio of the benchmark is. We want to choose an information ratio, the highest information ratio we can, or achieve the highest information ratio we can to get the highest Sharpe ratio on the portfolio. Well, look what happens to it now where the transfer coefficient goes, because you got to dial that back, right? You're not going to get the highest Sharpe ratio. As soon as you start constraining the portfolio, you're not going to be able to achieve that. So notice that this is IR for the unconstrained portfolio, much as it is here, but we stick the transfer coefficient squared in front of it. Later on, we'll interpret the transfer coefficient squared. It's not worth interpreting now. Just remember that's where it goes. So we can adjust active risk and return by investing in both the actively managed and the benchmark portfolios. So let's see how this is done. The expected information ratio is the single best criterion for assessing active performance among actively managed funds with the same benchmark. So I'm combining LOSD in here now as well, again, which wants us to explain how the information ratio may be used in selecting and evaluating a manager. Well, that's exactly what we would do is we would evaluate their ability to generate active return by the size of their information ratio. For any given asset class, an investor should choose the manager with the highest information ratio. So let's look at an example of this in practice and see how we would combine the optimal portfolio with the benchmark portfolio to achieve this level of optimal risk, given that we have a transfer coefficient that is constraining. In other words, it's less than 1. All right, so across the top here I have our two formulas that we're going to need. The calculation of the optimal amount of active risk, and then finally the calculation of what the Sharpe ratio for the portfolio will be. And let's assume that we have some observations we can make. We have an information ratio, based on optimal weights now, unconstrained weights, the information ratio of 0.3. The benchmark that our performance is being referred or related to. The Sharpe ratio on the benchmark is 0.4, and the benchmark has a standard deviation of returns of 0.16, and we have some constraints, which brings our transfer coefficient down to 0.5. So there's quite a few constraints there. What is the optimal amount of aggressiveness we can now take, given that we have a transfer coefficient of 0.5? Well, it's the original formulation that we had, which was this over here, scaled down by the transfer coefficient. Notice that it would have been this amount, but we multiply it by 0.5. So that's 6%. In other words, it cuts the active risk in half. Basically, it cuts the active risk in half. So the Sharpe ratio that we can achieve is 0.043. Notice the Sharpe ratio on the benchmark was 0.04. This is 0.043. If the constrained portfolio has a standard deviation of active return of 8%, and the optimal amount, we just said the optimal amount is 6%, we got a problem. We got to bring this down. Here's how we can combine the benchmark portfolio with the active portfolio to get that down to 0.08. The weighting on the benchmark will be 1 minus the optimal amount of risk that we can take over the actual amount of risk. We can take 6%. We're currently at 8%, so that's 75%. The amount of risk we can take represents 75% of the risk we are taking. So the weight on the benchmark is 1 minus 0.75, or 25%. The weighting on the portfolio is 75%. So if we have $1 million, $250,000 goes into buying the securities of the benchmark, replicating the benchmark. The other $750,000 stays in the actively managed portfolio, which would give us an active risk of 6%. All right, one more screen to get through, and then we have 2 really quick learning objectives to get done. So let's just tighten up this section here. It may have occurred to you at this point that, hang on a second, you know what? These constraints, I mean, they can really hold back a manager, can't they? Is it fair to evaluate a manager that's facing a lot of constraints based on what those constraints hold the manager back from doing? In other words, let's say that I'm the manager and I'm capable of great things, but you put so many constraints on me that the transfer coefficient is really low, so the amount of active risk I can take on, the optimal amount of active risk, is really low, and if I'm constrained on that, then I'm constrained on my return, and if I'm being paid for performance, You're the one holding back my performance, buddy boy, not me. Here's how I want to be evaluated. I want to be evaluated based on the performance I could have done if I was unconstrained. The constraints, that's on you. You are to blame for that. I want to be rewarded on what I could have done without your constraints, and you take the blame for the constraints, not me. Well, we can do that. We can tear apart the actual active return into two components. A component based on what would have happened without constraints, and one that happened with constraints. So here's what we have. We have a conditional return. The expected return conditional on the realized information coefficient. We've used IC previously to represent the expected forecasting ability. We're going to use ICR to represent the realized forecasting ability. So this is what I was able to do after the fact. We can measure it. I want to be rewarded on that, but it's this constraint that's holding me back, right? So here's what we're going to do. We can calculate the expected active return conditional on this being real now. The information coefficient is real. We know what it is equal to TC, that's our constraints, multiplied by the realized information coefficient, multiplied by the square root of BR, and of course the active risk. We've seen this before. That is just, if we don't have the condition, the expected return on the expected active return is equal to all of this without the R. So we can rewrite this in terms of this, the realized active return. This is realized now. We can measure this. The realized active return came from two parts. It came from the expected return we would have got based on how good the manager was. This is the realized information coefficient. So if that information coefficient could have been translated entirely into return, that's the return it would have been. That's it right there. There's skill plus noise. What is noise? Those are the constraints. Now, sometimes it can work out the constraints take away from your return, but sometimes it can work out the constraints, you know what, they held you back from making a lot of stupid mistakes. They can actually add to your return, so we just put plus noise. The noise could be a negative or a positive number. So I say here, skill may be positive or negative. The manager may not actually be skilled. It may actually be negative. And the constraints may be positive or negative. So we take our constraints and we wrap it up into noise. And we say, okay, so you actually did this much. However, if you were unconstrained, we would have expected a return of this much given how good you actually were. We're not using expected now, we're using realized. How good you actually were should have translated into this. If there's a difference between that, it's noise. And you're going to be rewarded on this and not on this. So let's just have a look at it now. Now, I said earlier I would try to explain this TC squared that we saw in one of the other formulas. So let's explain what that is now. When we look at a realized variance or standard deviation of returns, of active returns, it turns out that there's a relationship with the constraints is TC squared. And 1 minus TC squared, we're going to look at how we can interpret these. So remember that we can break down our active return into two components, TC squared and 1 minus TC squared. So let's have a look at what we have here. Let's say that we have a situation where we analyzed our breadth was 100, so there was 100 securities in the portfolio. Information coefficient was 0.05. Now notice, this is not an IC sub R, it's just IC. So this is the expected forecasting ability of 0.5, a transfer coefficient of 0.8, and active risk of 4%. The expected active return, fill it all in, would be 1.6%. What if the realized information coefficient was negative 0.1? What do we got to say about this guy? Fire him, right? So it's negative 0.1. Well, what would have been the return if you actually had negative 0.1? What would have been the return? The return would have been negative 3.2%. Negative 3. So if the active return is negative 2.6%, noise was plus 6%. The expected return based on your terrible performance would have been negative 3.2%. If we actually returned 2.6%, guess what? The constraints saved you a bit. You were so bad that if you had more full reign, you would have done even worse. So the constraints actually improved your performance. So you want to be rewarded based on who you are? You're negative 3.2, not negative 2.6. You're worse than you think. Now, let's talk about how we can attribute, how we've broken down the active risk into two components. Active risk can be attributed to the standard deviation of the information coefficient, which is 64%. The other 36 is attributed to noise. So of the entire active risk, 64% of it is attributed to the manager and his performance, and 36% of it is just attributed to noise or the constraints. So you can actually break that down. Now, we've done that very quickly and very naively. The book doesn't really go into detail about that. It mentions it, so I thought I'd mention it as well. And the book doesn't spend a lot of time on this section as well, half a page, so I didn't spend much more on that either. But I think you could see that there was a problem with that transfer coefficient, that if the transfer coefficient gets lower and lower and lower, my ability to generate active return gets harder and harder and harder. It becomes a more and more difficult job, which means even if I'm really good, if I have a transfer coefficient of 0.1, there's not a lot I can do. So I want to be rewarded on something else. Well, guess what? This just shows you that yes, you can. We can split it apart between an expected return and a noise component. All right, we're on our last two learning objectives, LOS, E, and F. Each one is only one screen long, 3-4 minutes on each here. LOS-E, compare active management strategies, including market timing and security selection, and evaluate strategy changes in terms of the fundamental law of active management. So the section in the book really goes into, it has 3 examples, and it goes into heavy detail on those specific examples. And the examples are big and detailed enough that they don't lend themselves well to being on the page here. So I'm going to extract the essence of the stories and give that to you without actually giving you the stories. And you can go ahead and read them. They'll read much easier after we have the stories. So to tell the story, we need 2 asset classes. So let's go with equities. Let's go with fixed income. So you can have a portfolio where you're just running equities. You can have a portfolio where you're just running fixed income, or you can have a portfolio where you have a weighting on equities and fixed income. So there's our 3 stories that we're going to tell. For equities, we can take a cross-sectional approach. What does cross-sectional approach means? It means we look at end securities today, and we have some forecast over a period of time. We'll set our optimal weights, we'll overweight, we'll underweight, we'll invest, and off it goes. So our breadth would be the number of securities that we analyze. So we go from time t equals 0 all the way to time t equals t, whatever that time period is. That is our breadth. That's cross-sectional example. For fixed income, we might look at a time series analysis where we have a number of securities here, a number of bonds that we look at, and every quarter we might reevaluate. Next quarter we might reevaluate. Next quarter we might reevaluate because of they're all very sensitive to interest rate changes. So we might reevaluate our measures of duration, convexity, things like that on each quarter. So in a situation where we're doing time series type of investing, or that's our strategy, our breadth is the number of securities times how many times we reevaluate it, n times t. We could be in the third scenario where we have a weighting on equities and a weighting on fixed income, and at time t equals 0, we have 2 asset classes. We just make the decision to overweight equities and underweight bonds. The next time we make the decision, we say, no, let's rotate, let's overweight bonds and underweight equities. The next time, we do the same thing. The next time, we make the same decision. This is market timing. Your attempt at timing the market by saying, let's go heavier in equities here, let's go heavier in bonds here, let's go heavier in equities here. That's market timing. Your breadth is the number of timing decisions you make. And that's T, because you're not going to do anything in the equity portfolio, really. All you're going to do is say, look, I'm going to have an equity ETF and a bond ETF, and I'm just going to move my weightings back and forth depending on which one I think is going to outperform. So cross-sectional over a period of time. Here we have time series. You have cross-sectional and time going on, and here we have market timing. And it all have indications for BR. And you'll recall that our expected active return was equal to TC, IC, and the square root of BR plus the active risk. Well, you can see that if we get this higher, we get this higher. So it seems to me that, well, why wouldn't you just, take your 100 securities and then analyze them every single day? You'd have a really high BR, you'd have a higher expected active return. That's not really a realistic strategy for doing it, and there is a problem once we get to that. Now, let's just remind ourselves of two conditions on BR. Number one, the first condition is that all of our decisions are independent. If we're analyzing 100 securities in here, and if we analyze each of the 100 securities and make an independent decision on those 100, well, then breadth is 100. But if we're analyzing those securities and we group them into four classes, we say, well, these are extreme value stocks, these are extreme growth stocks, this group over here is mild growth, and this is mild value. And we decide to completely overweight all the aggressive or really undervalued stocks, all the overvalued stocks, whatever. However you want to break those four groups up, you decide to overweight and underweight those. Those are not in, you don't have 100 independent decisions anymore, because there might be 30 stocks in a particular group and you decide to overweight all of them because they belong to a specific group. All those 30 decisions are dependent now, not independent. So if you did that, your breadth drops dramatically. So there's an issue with how you would measure breadth under these situations. Let's go down here. The estimated or the expected active return we know is a function of these four variables, and our information ratio is a function of these three variables. For an unconstrained portfolio, that is, the transfer coefficient equal to 1, the IR is invariant to changes in active risk. The information ratio is invariant. Because look here's your information ratio. Is active risk anywhere in there? No. So for an unconstrained portfolio, the IR is invariant to changes in risk. But, and this is tricky now, for a constrained portfolio, as active risk increases, the IR drops. Well, hang on a second. I'm looking at the formula here. I don't see active risk in here anywhere. So if you increase active risk, wouldn't expected active return increase? Now, this is for an unconstrained portfolio. For a constrained portfolio now, we're saying for a constrained portfolio, which means TC is less than 1, as we increase this, why would we expect the IR, the information ratio, to decrease? Well, it's because the constraints become more binding. They become more binding. What does that mean? Look down here. The transfer coefficient is the correlation between the optimal active weights and the active weights we can actually take. If we say that, hey, look, you can go ahead and really increase that, suddenly these active weights get far more aggressive. And that makes this correlation drop even more, because this is reality. So the more fantasy you think you can build into this, the less correlation there is between these. The transfer coefficient drops. There it is right there. The transfer coefficient drops. These two things will remain the same. The information ratio drops. As active risk increases, aggressiveness increases, the absolute value of the active weights increase. That lowers the correlation between what you can do with what you'd like to do. It lowers that correlation and finds its way there. You must be able to see that logic, that for a constrained portfolio, if we increase the amount of optimal active risk, we actually decrease the information ratio, because the correlation between what we want to do and what we can do actually drops, and it lowers this. And if these two things are constant, it lowers the information ratio. So that's one of the things you have to look at in practice is that you got to watch for the level of active risk and understand that it does affect the information ratio. So what's the big takeaways from these three? It's all about pretty much about your BR. If you're doing cross-sectional work, you have a number of securities here. Are you analyzing them all independently? Or are you grouping some together in groups and making decisions for the whole group? That'll affect your BR. For your time series, it's the number of securities times the amount of times that you do it. And if you're market timing, it's the amount of decisions you make on switching your weightings from asset class to asset class. Okay, we're on our last learning objective here, LOSF, one screen long. Describe the practical strengths and limitations of the fundamental law of active management. And we're not really going to get into the practical strengths. The book really doesn't get into the practical strengths either, but it does make a mention of saying, look, this is just as powerful as any mean variance optimization that you've done, because this is what this is, mean variance optimization. So everything we did in level 1 about selecting the optimal portfolio, combining with the risk-free asset, and choosing the level of risk that you want, going into active management, and everything that we've done with mean variance optimization, yeah, it has great strength because it informs us a lot. It has the same limitations as mean variance optimization. It relies on a normal distribution of returns, and that may not be realistic. So it has the same weaknesses as all that. But there are some specific limitations we should talk about. Number one, ex ante measurement of skill. That means before the fact. Investors tend to overestimate their skill. So nobody comes along and says, my information coefficient, oh, it's negative. Oh, I'm going to destroy value. Can I have the job, please? Everyone's got a positive information coefficient. Whether it actually happens or not, that's a different story, right? But investors tend to overestimate their skill. Forecasting ability differs among different asset segments and over time. And I know that for sure, that it differs over certain asset segments. I know when I was involved in equities quite heavily, one group of equities that I just was terrible at figuring out what direction I thought they were going. Clothing retailers. For some reason, I just couldn't figure it out. And it differs over time. And especially if you follow a particular stock for a period of time, it's hard to switch. It's hard to go from, nope, this company's dead in the water now. It usually takes a long period of time and a lot of evidence, and usually you're late in adjusting your opinion on a stock. For example, Apple. I've been saying throughout the videos now, and probably for the last 6 months or so, Apple's a short. It's over. It's done. And I don't say that from an analyst perspective. I say that from a user's perspective. I use a lot of their product. And every time I upgrade or they shove an upgrade down my throat with the software, it gets a little bit worse. It doesn't work as well as it used to. It's a little bit more clunky. It's a little bit slower. And slowly, they're walking themselves over to Microsoft caliber software and Microsoft caliber product. Well, if I'm going to get Microsoft caliber product, I want to be paying Microsoft caliber prices, which means these iMacs got to be costing me $499, not $24.99. So they're about $2,000 too proud on their computers right now. I think it's over for them. In devices, there are many devices out there now that surpass the quality and the functionality of what they're putting out. And I think they're focused less and less on beautiful design and beautiful products that work well. And they're focused more and more on their supply channel, their costs, their margins. You have a bean counter running the show. You don't have a designer. You don't have a dreamer. If you're going to have a technology company, your CEO better be a dreamer. Have the operating officer in there that's the bean counter, but the dreamer better be in charge. Apple doesn't have a dreamer anymore. It has a CFO pretending to be a CEO, and they're missing a dreamer, and you can tell in the type of stuff that they're putting out now that the dream is gone. The dream is over. So I think it's a massive short. It's hard if you're an analyst over time, following Apple for 10 years, following this big success story, to say that. It's very hard. because you can't remove yourself from it. So your forecasting ability ends up changing because you get nudged out of there because you realize that you're always wrong, as opposed to being ahead of the game. Here's the bigger threat: independence of investment decisions, or the lack of the independence. That's one of the assumptions here in getting to BR, is that you have this independence of investment decisions, or that your BR is the number of independent investment decisions that you make. But how independent are all your decisions, right? Non-independence can result in very large measures of BR and large amounts of active risk active return versus active risk. And the book is a good example of the case of arbitrage, and arbitrage is two securities. Well, to do arbitrage, those are not two independent decisions. That is one decision. So your N, you think, is 2, but your N is not really 2. So the book gives an example of how to adjust for that. Your BR is your N over 1 minus N minus 1, and the correlation between the two securities. So in arbitrage, the correlation between those two securities would be extremely high. So let's just take merger arbitrage, for example, and how the pricing would move on that. That correlation would be extremely high. So let's say you had two securities with a correlation of 0.8. 1 minus 2 minus 1 to 0.8 is 2. What is this? 2 minus 1, 0.8 over 0.2. You have a BR of 10. A BR of 10, and you only have two securities. And suddenly it's saying that you had 10 independent decisions, but you really only had two securities. So when you don't have independence, suddenly, if you're adjusting for it, you end up with large BRs, right? Fixed income portfolios, bond returns are much more highly correlated. One of the other things we said for independence is that the correlation between the active returns, there is no correlation between the active returns. Well, for bond portfolios, there is. Time series, increasing the rebalancing frequency increases BR. So if we say that, look, we have 10 securities and we go a full year and we reevaluate the 10, those are 10 independent events for the year. But if you say, well, let's go every quarter, well, suddenly now your BR is 40 out of 10 securities. Increases BR and increases IR, but decisions are less likely to be independent, because from time to time, you're not going to reevaluate everything all at the same time. In time series, your decisions are more likely to be dependent on the decision you made last time. Is there any reason to change? No, let it stay. Any reason to change? No, let it stay. So that you have this dependence over time, so that your BR really isn't 40, it's something lower than that 40. So it's the independence of investment decisions that make this hard to work with, because you have to modify your BR. I think that's more detail than what you're going to be required to know. You'll be required to know the fundamental law and those 4 variables in there, the relationship of those 4 variables to the expected active return, so that if this increased, what would happen here? If that increased, what would happen there? So more heavily on the stuff we've already done. But I think that by looking at its application and pushing the limits of what the chapter wanted, gaining a deeper understanding makes it a lot easier to understand, and you don't have to memorize stuff.